So let's start with again the agenda. So again, we'll go with where the market is right now. Three things weighing on stocks. So we'll talk about COVID-19 and the Omicron surge at the beginning of this year, Russia's invasion of Ukraine, and inflation hitting a 40-year high. Then we'll actually go through and talk a little bit about how the economy is really doing, our recession risk forecast and economic data. We'll discuss our strategy moving into the second half of 22 and some of our more frequent model updates, focusing on our domestic market and sticking with the stocks. And then we'll even go through and do a case study on where there are opportunities. And again, we're going to finish up with questions and answers at the end. So let's start with just kind of where the markets are. On this graph, what you're seeing here is the three major markets that we invest in currently. The S&P 500, which is the purple line. You can see that's down about 15% this year. And this is, again, January 1 through yesterday. The second market is the MSCI EFA. EFA stands for Europe, Asia, and Far East. It's really an index that's comprised of developed markets that are in Europe and Asia. So this would be Japan, Germany, Australia, the UK, those kinds of countries. And then the MSCI Emerging Markets Index, which would include countries like Brazil, India, Russia before they got kicked out of it, and China. So those are that's going to be the blue line. And you can see that kind of across the board, markets are down kind of in unison this year, 13, 14, and 15% respectively. And then within even a market like the S&P 500, what you can see from this next slide is that all but one sector is actually down for the year. So what you're seeing here, the blue graphs are the sectors of the economy as measured by their importance within the S&P 500 index. So for example, 29% of the S&P 500 is tech stocks. And you can see that tech stocks are down 22.1% year to date. Healthcare is the next biggest sector. It's down 9.8%, and so on. Consumer discretionary. The notable exception, and I put this in green, is really the energy sector. And we kind of know why that is, right? So energy stocks have benefited this year from the high oil prices that were caused by Russia's invasion of Ukraine. And energy stocks have done very well, but energy, as you can see, is a very small kind of subcomponent of the market. It represents only 2.7% of the S&P 500. So again, for those people that were lucky to have some energy stocks in their portfolio, that has helped. But it's certainly, even if, let's say you overweighted this a lot, like double or triple what it would have gotten as a natural weight, it would not have made up for all of the losses in the other sectors. So again, pretty broad downturn across the board in the stock market. So what are some of the things weighing on stocks? Well, first was the COVID-19 Omicron variant at the beginning of the year. A lot of us don't really even remember this as much because it seems so long ago, but at the beginning of this year, if you all recall, we had the COVID from hell that was going to kill all of us. It was very contagious, and nobody really knew how deadly it was going to be. But the sheer number of cases was overwhelming at the time. That was then shortly followed by Russia's invasion of Ukraine, which continues, and we're now into our over 3 months that this war has been going on. It's the first major war in Europe in a long time, and of course the human suffering that's there is unimaginable. But there's also a lot of financial ramifications as a result of that war, which we'll discuss. And then more recently, we're also battling with higher than normal inflation. In fact, inflation, we got some numbers today that showed that inflation is still very, very high, and has, we have not seen inflation this high really since the early 80s, right? And so a lot of us are too young or weren't even born at the time when inflation was this high. And so some people that come in and talk to us today and say, well, I've never seen things this way. Well, it's like, well, because they haven't been this way since the late 70s, early 80s. So let's tackle each one of these in order. So let's start with Omicron. I'm going to just put up a couple of statistics here on Omicron, just so that you have something to look at while I go through and just give you a little bit of background on it. So we all know COVID-19 was not a hoax, but it was the world's first social media pandemic where fear was spread in a way that we have never seen before. Our goal with COVID-19 has been to provide a data-driven piece to put the pandemic in perspective for you. And through these fireside chats, we've tried to present factual data in a way that helped you minimize fear. What this data has consistently shown since the beginning of the pandemic was that those most at risk were a small subset of the population. And if you look at this graph here in the upper left, what you'll notice is that those that are 65 years and older, which make up approximately 16.3% of the population, have accounted for nearly 75% of all COVID deaths. In our opinion, focusing resources on the most vulnerable individuals instead of locking down the entire country would have resulted in better outcomes for both public health and an economic perspective. As history looks back, we believe locking down the economy will be viewed as one of the most damaging public policy mistakes in world history. The shutdowns destroyed supply chains, put millions of people out of work, hurt the young by eliminating in-person learning, damaged mental health, caused the delay of important screenings for other healthcare problems, and led to government spending spree of over $5 trillion. We are now dealing with the costs of these shutdowns, and while we can't assess the long-term sociological problems, we do know that the economic data continues to improve. The US and other Western countries have seen case counts from Omicron collapse, and now it looks clear that the worst of that wave is behind us. As a result of that, and in conjunction with widespread population immunity to vaccination and prior infection, restrictions are starting to be removed at a rapid rate around the world. It's important to remember that seasonality plays a big part in the spread of the virus, and cases could always rise once again. But for now, it looks like the status quo of lockdowns, mask mandates, vaccine passports over the past 2 years may be coming to an end. The lagging effects of the draconian response to the pandemic will continue to be felt for years to come, and the long-term economic consequences from the government spending and money printing. But it seems clear that confidence is returning and the pandemic is waning, and the economy continues to improve. There are a couple of other things that I put on here. One of the things that I know that was just lifted, and I believe it was the other day, was the need to provide a negative test when coming back into the United States through an airplane. So that was just removed yesterday. So we do see that even though COVID's been a big part of our lives, a lot of the control and some of the policies are being dismantled, and that shows us that life is returning back to normal. Now, the second thing that the market's grappling with is Russia's invasion of Ukraine, and that's really shown on this map here. And many of you know, obviously, Ukraine is a very largest country in Europe by by land area. It's in Eastern Europe, and what I wanted to show with this is really just kind of where the fighting's happening. And we did a fireside chat a while ago specifically on Russia's invasion of Ukraine. But if you recall, at the time, Russia was invading from the north. Kiev was really in significant turmoil, but since then, Ukrainians have been able to push back the Russians, and most of the fighting is now happening in the Donbas region here in the east, and then in the south near Mariupol and Crimea. So it's, in our view, at this point, Russia-Ukraine will over time, we think, lead to a ceasefire. Both sides are sustaining very heavy casualties, and the war is very expensive. We believe Russia, once they either take over the Donbas region or once they believe that they've achieved their objectives, may look for a ceasefire and try to fully annex the land that they've taken. Obviously, from a human standpoint, this has been an epic tragedy, and from a market standpoint, it just wants the fighting to stop, right? And so if Russia largely accomplishes enough to declare a victory and comes to the peace tables or the table, the markets may embrace that result. And for now, though, commodities, especially oil and wheat, remain elevated and near pre-war levels. And I'm sorry, nowhere near pre-war levels. So those are the two major risks to this, is that if the war continues, Europe is going to obviously have to grapple with the idea that they're going to have to get their energy supplies elsewhere. And we'll talk about that opportunity because that may end up being an opportunity for the US to sell more natural gas and oil to Europe. But also Europe is going to have to spend more money on defense and rearming itself, to kind of counter the threat from Russia. So that may weigh on their economic growth in the near term too. And then let's talk about inflation. Inflation, how bad is it? Will it get worse? Inflation hasn't really been this high since 1982. We did this presentation actually yesterday. We finished it. So as of today, it's actually closer to 1980 in terms of how bad it's been. And you can see here really that we've had inflation like this in the past, but you really have to go back a long ways to see it this high. And why has it gotten this bad? How did it get to this point? Well, inflation's really caused by three things. There's demand side inflation, there's supply side, and then there's money printing inflation. So demand driven inflation would be what we see in the housing market. Today, there's a lot of people that want to buy new houses. We're also seeing large amounts of migration from places like the West Coast, LA, I'm thinking of, or even like the East Coast, like New York, to places in the Sun Belt. Think of like Phoenix, Arizona, Atlanta, Georgia, Miami, even places like Charlotte, Austin are getting a lot of influx. And so those markets, it's very difficult to just build houses super quickly for all the people that want to move to these places. And so those markets have absolutely been booming. And when you look nationwide, the housing market's up probably 20% year over year. So 40% of the inflation number is coming from housing. And housing is really driven by demand, excess demand. Now, we also have supply side inflation. Supply side inflation is really caused when demand isn't necessarily through the roof, but supply is constrained. So think of automotive as supply side inflation. We know that there's been a chip shortage due to the disruptions to supply chains caused by COVID. Those supply chains, although they've gotten better, haven't fully recovered yet. And the number of new cars that are coming off the line is still way below its pre-pandemic levels, which means that even though we haven't, let's say, doubled the number of people that want to buy cars, the number of people that want to buy cars today have fewer cars that they can buy, which means that those cars become more expensive, especially the used ones. And so we're seeing some supply side inflation related to that. And then, of course, there's the money printing. And, we talked about this when we talked about COVID-19, but there's been over $5 trillion that the Fed has printed and injected into the economy. And I want to be really clear. The Fed did print money back in 2008 as well. So some people say, why didn't that lead to a lot of inflation? Well, because at that time, the money wasn't really spent. It wasn't used. It was just put into banks, capital reserves. So if I print a bunch of money and I stick it in a bank account and nobody ever gets to touch it, it doesn't actually increase the velocity of money. It doesn't increase the money in circulation. But in this time around, we didn't just put it in the bank and left it there. We gave it to people. We gave people PPP loans through the small businesses. We gave people stimulus checks. There were very generous unemployment benefits that lasted a long time. And so all of that money is still out here in the economy. And even though the Fed is trying to rein it in, and they've committed to essentially the opposite of printing money, so it's called tapering, but essentially it's destroying money. And they're going to be destroying close to $95 billion a month starting this month, which is over $1 trillion a year. It's going to take them at that rate over 5 years to take out what they've put into the economy. So they are doing the right thing, but the scale at which we've printed money is extraordinary and has led to inflation as well. So when we look at the components of inflation, again, you can see housing and transport make up the vast majority. Over 57% now come from those two areas. And they've been the two that have been the primary drivers of inflation. The Fed also knows that most people buy houses and cars with credit, not with cash. And that's why the increasing of interest rates is a necessary, although bitter pill to swallow when it comes to solving this problem. Just in the last 5 months, as an example, the value or the price of a house, the median home in the United States, has gone up by 40%, right? Part of that is that the interest rate to buy a house went up from about 3% to about 5.1%. So that's the 30-year mortgage rate. And then the other part of it is that house prices have just continued to climb to where that payment that somebody would have been making is now 40% higher than it was at the very beginning of the year. So obviously that's going to put a little bit of a damper on the housing market, which is exactly what we need. But there's going to be a lagging effect on that. I want people to understand that the Fed raising interest rates won't solve this immediately. We have to be patient and know that it sometimes takes a year from the time that they raise interest rates to where that gets pushed out into the economy and people start making decisions based off of that. But certainly that's going to help here. So let's talk about the last one, which is the one that everybody talks about when they come into meetings, which is the price of gas. And although the price of gas is something that everybody loves to complain about, I do want to just explain that this is one of those things that's not that significant economically. And here's why. If you look at the price of gas, which is this purple line that you see, this is the retail price of gas over the last 10 years. So 10 years ago, gas was nearly $4 a gallon, $3.70 something cents a gallon. And now I'm sure it's somewhere close to $5. When you look at that, that's about a 37% increase. The reason why it looks so extreme to us is that for the longest time, we got like a 50% cut in the price of gas. So we had extraordinarily cheap gas for many, many years. And now the gas prices have gone up, and they've gone up 37% over that 10-year time frame. What most people don't realize, though, is that their salaries have actually gone up 63% over that same time frame. These are U.S. wages and salaries, and their percentage change during this 10-year period. So what does that mean? That means that our ability to pay those gas prices is there. Okay. On average, about 10 years ago, people used to spend about 3.7% of what they made on gas. And today, they spend somewhere around 2.5% of what they make on gas. And that's partly because of the fact that their incomes have risen faster than the price of gas. The other reason is that some people aren't using as much gas anymore. Think of the people that are working from home. Think of the people that are driving hybrids or electric cars that don't use gas at all. And then think of also the people that are driving gas cars, but those gas cars are much more fuel efficient. 10 years ago, it wasn't very common to see an inline 4-cylinder engine with twin turbochargers. Today, that's the most popular engine that we see. Back then, it was V6 and V8 engines, which are less fuel efficient. So today, when you're driving a car, that car that you're driving is much more fuel efficient than one that you would have gotten 10 years ago that was a gas guzzler. So even though the price of gas is something we love to complain about, I know that the media harps on this. From an economic standpoint, this is not one of those areas where we really feel it's insurmountable. It's a problem, but it's not the biggest problem that we have. So let's talk a little bit about where the economy is and where our forecast shows it going over the next couple of months and years. Our recession risk forecast continues to show that the economy is expanding, and it's expanding at a moderate rate. We don't have a good word to describe a high inflationary environment. So a lot of times people will come into meetings and ask me, how are you doing? Or how are you doing through the recession? And I have to remind them that there's no recession. We're not in a recession right now. And we may not be in one this year. The probability of recession, according to our recession risk forecast, is under 30%. And that's because even though we see that there's some cracks that are forming, those cracks today aren't at a scale where we would predict or forecast an imminent recession. As you can see, from March to April and May, there's been some deterioration, but the recession risk forecast is primarily in the green. Housing permits, job sentiment, jobless claims are all solid. These are really good indicators for how the consumer is doing. If we're looking at business activity, truck shipments, profit margins also show very, very healthy signs. The number of shipments that we're seeing continues to climb, which means people are buying stuff and that stuff's being delivered. The only two areas that we see some problems, whether it comes to the consumer or business activity, is in wage growth and in commodities. Commodities we've already talked about with oil and gas. And then wage growth, the reason why this is in the red is because at this point, we actually have a labor shortage. So we have one of the lowest unemployment rates in the last 50 years. This is primarily due to the kind of start-stop nature of the US economy during these rolling Omicron and other surges from COVID, and the desire for a lot of baby boomers to retire. And so wage growth today is high because there's pent-up demand and there's not enough supply. And so for every job opening today, or two job openings, there's one worker to fill them. Now, we're seeing some signs of that abating, but wage growth today is, year over year, it used to be around 6%. In the most recent numbers, it's dropped to somewhere around 3.7%. Wage growth is still climbing, but we're seeing a little bit of relief there. And then financial indicators, which are mostly government driven and really controlled by the Fed, money supply and credit spreads have shown some weakness. And of course, this is expected when the Fed is tightening, right? When they're raising interest rates and they're taking money out of the economy, that's to be expected. Now, what does the economic data tell us as of June 8th? What we can see here is that the United States is still a very, very healthy economy, $21 trillion economy, the biggest in the world by a lot. You could see that the three main regions that we invest in, US, China, and the Eurozone, are all growing at this point. And even though we've seen a little bit of contraction in the most recent quarter, these are very, very healthy clips of growth. And remember, real GDP is inflation adjusted, right? So our actual growth is this number plus the inflation rate. So if you look at how big was the US economy a year ago, it was 3.6 plus 8.26. So it was nearly 12% smaller last year than it is today. Okay. Now, ideally, we'd love to have this number be higher and this number be lower, but combined is what creates nominal GDP. And so this is a healthy growth rate for us and higher than normal. We can also see that interest rates are at about 1%. And that's very different than what we see in Europe. So we've already started to tighten interest rates and to raise the cost of borrowing. Europe has not. That's because Europe has higher unemployment than us. So they're still working on getting their people back to work, where we have our people back to work. In fact, we have a labor shortage, like I mentioned. So our strategy moving forward, what are we doing and how are we changing things? So number one, we've recently adapted our models to quarterly updates rather than annual updates. Historically, we would update our models sometime in June, at the end of June, and that really just looked at what assets have gone up, what assets have gone down, and more importantly, how are those assets valued in comparison to their long-term averages. So let's say, for example, stocks make a long-term average of 10, but in the last couple of years, they've made 15. We might underweight them or vice versa. Those models are now going to be updated on a quarterly basis, which just gives us data that's a little bit more fresh. Of course, keep in mind that just because our models update quarterly doesn't necessarily mean we're going to need to trade more often. There's kind of a double-edged sword when it comes to trading. The more you trade, the more taxes you pay. So we want to be very conscious of the fact that whenever we trade, we need to trade with tax efficiency in mind. But those model updates being quarterly are going to definitely help us to be able to more quickly react to any types of macroeconomic events that are happening, like the war in Ukraine or the increasing inflation numbers that we're seeing. We're also bringing more money back to the US. Why is that? One of the things that we think is that the primary risks that we see today are, again, the war in Ukraine and Russia and what that's doing to Europe and some of the need for Europe to remilitarize a little bit and also to essentially focus more of their energy on diversifying their energy supplies away from Russia, which we think is going to be painful. That's going to create a little bit of a damper on European stocks. So we want to underweight those. And then in China, China is not really doing what the US is doing in terms of COVID. China's in fact doubling down on lockdowns and mandates. And we don't think that that's a good thing. We think that there's going to be a lot of economic pain as a result of that. And even though they're looking like they're going to hopefully not take as crazy of an approach with Beijing as they did with Shanghai. Shanghai was under lockdown for many months. and did cause a lot of economic turmoil. So we want to be cautious when investing in China as well, just because of their zero COVID policy. We are sticking with stocks and cryptocurrency. We think stocks and cryptocurrency are both undervalued at this point. And we're minimizing bonds and real estate. And again, the reason why we minimize those, although there are in the portfolio, is bonds and real estate are more affected by rising interest rates than stocks and cryptocurrency. And then there's a greater emphasis on larger and more value-oriented companies to create more balance. There is a risk that if the Federal Reserve acts too quickly and spends too much time raising interest rates, they could kill inflation, but also drag the US economy into recession with it. One of the things that we can do to protect ourselves under that scenario is to have larger and more value-oriented companies in the portfolio. Those companies, because they have a dividend component, not only can provide income for our clients along the way, but could also make it to where there's a little bit more downside protection if that scenario were to materialize, even though we think that that's not a likely scenario. So let's talk about opportunity and where we see it. So here is the case of two companies. One is a company called NVIDIA, and then the other one is a company called ExxonMobil. NVIDIA, as you can see here, has been growing like a weed. NVIDIA is a company that makes semiconductor chips, and primarily they make GPUs, which is graphic processor units that are used in computers, smartphones, neural networks for self-driving cars, and also in cryptocurrency mining. As you can imagine, the demand for their product has just skyrocketed, and their sales have gone along with it. Their sales have been up almost 500% in the last 8 years. ExxonMobil, on the other hand, sells oil, and as you can see, from 2014 to 2021, the company has actually shrank by about 30%. And the reason why I show this example is that from this, you would get the idea that, well, NVIDIA stock should be booming and ExxonMobil stock should be tanking. But in fact, in the very short term, the exact opposite has happened. ExxonMobil stock is up about 71% this year, and NVIDIA is down 38%. This creates an opportunity for us because this is short-term thinking at its best. People chasing something that is hot right now without really thinking about long-term how this might affect things. And if you look at NVIDIA versus Exxon and you were to go back something like 10 years, what you would notice is that if you had invested $10,000 in Exxon 10 years ago, you'd have about $19,000 today. So you would have doubled your money. If you had invested $10,000 in NVIDIA, you would have gone from $10,000 to $648,000. And even though that's down from 1.2 million, which is what it was back in November, that is still a much, much larger number. So we would encourage investors to kind of be patient, take the long-term view, and realize that this market downturn that we're experiencing right now is creating a lot of great opportunities for us to make money in stocks like NVIDIA. So with that, I'm going to invite Tommy Harris and Eric Tomaszewski to join me, and we're going to be answering some of your questions. Again, if you have questions, please put them in the chat section, and we've got a couple of them right here, I think, that Holly's going to start with.
Sure. So we're going to start the Q&A session now. As a reminder, you can submit it via the chat feature or by responding to the invite or reminder email invitation that you received. Our first question was submitted via email previously, and it is, I have a friend who is telling me to sell out of the market and sit in cash or buy CDs or I bonds. What do you think of this strategy?
I could take that one. So there's really if you were to think of stocks as a spectrum, on the right-hand side of the spectrum would be cash, right? That's the most conservative thing that you can invest in. It's going to have no price appreciation or depreciation measurably. On the left-hand side of the spectrum is probably the stock market, or maybe cryptocurrency would be even more aggressive. But essentially, that would be something that would be quite volatile. So if you put all of your money in cash as an extreme, right? Today, if you had $100 in the bank, next year at this time, just based on the inflation rate that we've got, that $100 would be worth $91.5, meaning it would still say 100, but it would buy $91.50 worth of stuff. So you're essentially guaranteeing yourself an 8.5% loss. Okay, so that's one option. Option number two is you can put the money in the stock market, which of course there, long term, you will beat inflation. The stock market historically on average has beaten inflation 3-1. So over time, you will make more money than inflation. However, you're dealing with the volatility that exists in the stock market. So here's how I would just explain the question. If you need the money in, let's say, less than a year, and you have some major use for it that you're going to need, then it's okay to keep it in the bank, because we don't know within the next year if the stock market's going to be up from here or down. I think it will be up, but I can't guarantee that. So in that situation, I would say keep it in the bank, knowing that you're going to lose 8.5%. On the other hand, if the money is for your children's education, for your retirement, for something that's farther out, then putting money in the stock market makes a lot of sense. Over time, you're going to beat inflation, but you will deal with a lot of volatility along the way. So just know that the volatility is the price that you pay for that outperformance.
Great. Another question that was submitted: with bonds going down, what should I do with my cash reserve?
Okay, I'll take that one too. I get all the hard ones today. So the cash reserve is an account that we've put together that is an all bond portfolio, and it is made up of short-term, intermediate-term, long-term bonds. The purpose of the cash reserve is to beat inflation over time. Okay. Typically, most of our clients have money in checking, savings accounts, and then the cash reserve is kind of like the third tier of their investment strategy. Cash reserve accounts, because they're invested primarily in the bond market, are going to get affected by rising interest rates. However, because interest rates have already risen and the Fed has clearly articulated that they intend to raise rates again at this next meeting, the one after, and the one after, we think that the bond market has already priced in kind of a worst case scenario for the Fed. Also, historically, if you look at bonds have never had a 3-year losing streak, right? So if the bonds are down this year, and let's say you were to say, are they going to be down 3 years from now? Probably not, right? And so bonds do present a pretty good opportunity at this point, partially because every new bond that comes out today is paying greater interest. So for example, a mortgage-backed security a year and a half ago was probably paying 3% interest, whereas a mortgage-backed security that you're buying today is paying over 5% interest. 5% is a very attractive rate to earn on something. And if you plan on keeping that bond for a while, like to its maturity, you're going to get that 5% interest every year. So I think the bond market is a great place to invest. It's not as good as the stock market, but I certainly think that it's a great way to dampen volatility and to have something that's going to do better than cash.
Also, this is Eric. I want to add one item on that. It's also important to remember, and some of you have heard this in some of the recent meetings, where if you look at bonds historically, the bond market's been around for well over 100 years, massive amounts of data. Yet if you look at what's transpired so far this year, we are literally on track to have the worst start to a year ever in history. So when we compare this time frame to even other time frames that have been relatively comparable, and keeping in mind some of the things that Carl stated with the historic norm of how they've performed over time, we've looked at data over the next 4 months, 8 months, 12 months thereafter that actually shows a fairly bright future. So keep that in mind. Be optimistic with it, where arguably you should, even though you're getting some pain in the short term.
Great. We have another question via the chat. Crypto is imaginary, in my opinion. What is the strategy for buying and selling it?
I'd love to take that. And I deeply wish that the person who posed this question was here so we could actually debate. We don't have enough time for that. But whoever that was, feel free to reach out to us directly and we'll love to dive in and talk about this further. To keep it very high level, note that we do see a future with this. When you look at the overall change with money over time, going back to the advent of how we had the barter system and everything thereafter, we look at this as the next progression in that change. So even looking at where we were with fiat money, then from there you had digitized access to funds, right? We have that with our credit card and our debit cards. It's digitized, it's not real. I don't have $1 in my pocket. It's a card that looks like it's pretend, but it's all electronic. This is just the next progression of that. Also, if you look at some of the things that have been stated even more recently from research firms like Blockworks, where they've done very deliberate, very specific surveys. They just stated earlier this week, frankly, that over 90+% of merchants are strongly considering and actually putting their money where their mouth is to make that a part of their payment. And this is big institutions, big organizations like PayPal and many of the other ones that many of us use on a day-to-day basis. So our thought process right now is we lead in with Bitcoin and Ethereum. Those are the two leading digital assets within this entire space. They are the ones that are the most notable, have the longest track record, have been considered the most secure, and many other things. Our intent is to have a small sliver of portfolios to give you that diversification effect. And if you look at moments like this is not typically a moment to get distraught. If anything, this is an opportunity, in our opinion, to accumulate or rebalance portfolios into it, depending on if that is a part of your allocation. So please reach out separately. We could dive in further.
Awesome.
I have just one quick thing to add. I think when we just think about money in general, and this is a big frustration of mine because I've been working in this industry for a long time, money doesn't move very fast. If I want to send you money from your portfolios, for example, the fastest way I can send it to you today is a wire transfer, which is guaranteed 2 to 24 hours, right? And that's within the United States. In many cases, I could just, if I had the cash here, I could just get in my car and get to your house faster than that. If I want to send money internationally through the SWIFT system to a country like Venezuela, could take upwards of a week. Again, I can get on a plane and get there faster. That's really unacceptable in a 21st century economy. Crypto allows you to send money point to point, anywhere in the world to anywhere else in the world, in under 10 minutes for Bitcoin, under 10 seconds for Ethereum. That's innovation. So when Eric's talking about the future and he's talking about the future of money, it's really important to note that there are use cases and real life utility here to these inventions, and we should embrace those, because that's really innovation's kind of at the key to what we're trying to invest in for you.
Awesome. So we have another question that was submitted. I'm planning on retiring this year, and I'm scared that I won't have enough money in my retirement accounts due to the market drop. Do you think I should work another year or two, or still retire this year?
So that really depends. I think I just had a meeting with someone today that was that exact scenario. Typically, if we've got a well built retirement plan, the years where we have excess returns, like 2020, 2019, 20, and so on, right, should give you enough of a buffer zone to be able to weather a year like this, right? And keep in mind that even when you do retire, your portfolio does not need to be at an all-time high. And the reason is, in retirement, at most, you're going to be withdrawing 3 to 5% of your portfolio, which means 95, 96% of it is not going to be withdrawn. And of that 3 to 5% that you're withdrawing, a lot of that comes in the form of dividends and interest payments, right? Which typically happen whether the stock market or the bond market are up or down, right? So there's an income component to our portfolios for people that are nearing retirement and in retirement. It's the same for people that are retired right now. We've had people that have gone through multiple market cycles retired. And in some cases, their portfolio will drop 20, 30, 40, 50%, right? Well, does that mean now all of a sudden I'm going to ask a 70-year-old that's been retired for 15 years to go back to work? No. And in fact, the financial plans are built to account for not just that kind of a drop happening, but that drop will happen at some point during the retirement phase, because most of us are going to live 20 to 30 years in retirement.
Also, to add on to that, remember that we are a part of your team. We're here to give you a consultation, but to be there to constantly advise you and to handhold you through this process, to where what might even be more relevant is being able to be reiterated by us in a meeting or over a phone if you have questions or you want to dive in further, to get that confidence and maintain that confidence within your plan with how it's positioned. And in some cases, that could be as simple as being able to show you the progression of your plan over the next number of years, even with inflation, all the other unknowns that might arise into the future, but also being able to look at things like a Monte Carlo analysis. Now, that's just fancy verbiage for being able to look at thousands of different simulations of your plan in good markets, bad markets, maybe like this one, right? And then also in different markets. And it allows us to see in all of those different environments, regardless of when you're taking money or retiring, is the plan still viable? And in this case, you might benefit from it greatly. Feel free to reach out to us. We could dive in further.
Great. Another question. Do you think that interest rates are going to continue to increase, stay constant, or start coming back down?
So the Fed's been pretty clear that they're going to raise interest rates again. They're probably going to raise interest rates by another 0.5% at their next meeting, which is later this month. Then they're going to do it probably again in July, and then probably again in September. At least that's what the market expects. The goal, I'd say, is to get to somewhere around 2.5% interest rates, Fed funds rates, or higher. Today we're at 1%. I think just the inflation is persistently high right now, and the Fed is going to want to see inflation really come down in a significant way before they stop. So the Fed is going to be raising interest rates. That's going to that's priced into the market, and we expect that they'll do it. They'll continue to do that.
We have another question that was submitted via email. Do you think inflation has peaked?
I do. I think inflation is. We got a reading today that inflation was at about 8.58%. It's a little bit higher than last month. Last month was 8.26. The month before that, it was 8.4, I think. So I think it's kind of dancing around the top. The reason why I believe that inflation has peaked is because we're getting some additional data from other sources that kind of lead inflation a little bit. So one thing is that we see that wages aren't growing as much as they used to. Part of that is that some companies have essentially said that there's going to be hiring freezes, specifically in the tech sector, where they might have overbuilt after COVID. There's also a sign that certain retailers like Walmart, Home Depot, Target, which have all reported higher than normal inventories, and in fact, inventories that are kind of alarmingly high. In some cases, 30-40% higher month over month, or quarter over quarter. Sorry, that tells us that those retailers that might have been hiking up prices are going to roll back those prices. And so, yeah, I think inflation has peaked. But do we go back to 3%, 2.5% inflation anytime soon? No. And the reason is that, remember, the two big reasons why inflation is as high as it is because of housing and transportation. And the lagging effect of the Fed interest rate increases won't be felt for at least another couple months. They just started raising interest rates at the beginning of this year. Usually there's a 12-month lag from the time that they raise interest rates to the time that interest rates have an effect. So I think we're going to be waiting a while for us to get back to 2 to 3% inflation like the Fed would like. I think 4 to 5 is more likely in the short run here, but I do think we've peaked.
Another question from an attendee. You mentioned investing in value and growth companies earlier. What is Verde's view on investing in value companies and growth companies?
So let's break those down for a second. So a value company is a company that just think of it like if you're going to go to the store, okay? If you're a growth shopper, you're waiting in line for that new and exciting product that's coming out. So think of when the iPhone first came out and everybody was standing in line for hours. Sometimes they would camp out for a new iPhone. That's a growth stock, right? An iPhone. A value stock would be the person that goes to the grocery store and instead of buying the Kraft brand macaroni and cheese, they buy the store brand, right? Tastes about the same, costs half as much. And if they're a real good value shopper, they're going to find the dented can because that one's 50% off, right? So in general, a value stock might be a company that isn't necessarily growing. It might be mature at this point, but it's a cash cow. It's making money. It's a consumer staple in the sense that consumers really can't live without their products. So think about toilet paper, for example. Toilet paper is not sexy. Nobody waits in line to get toilet paper. But if there's a recession, you kind of need it, right? You might not need a new iPhone, but you're going to need toilet paper. So we all learned during COVID that toilet paper became a really exciting investment very quickly. So value stocks are stocks like toilet paper or groceries or defense contractors or telecom that are part of our lives. And we've been investing in value stocks all along, but we've balanced our portfolios a little bit more towards value recently, just to kind of hedge that possibility if the Fed does increase rates too quickly and does push us into a situation where a recession does happen sometime in the near future, that we're going to be prepared for that. So value stocks are part of that preparation.
Also remember, per some of the information that was covered earlier, that the intent of making sure that we're positioned properly for all the unknowns that are still to be determined. We are making it clear within the breakdown that we are more evenly distributed, especially within the US market, more particularly between growth and value related stocks. Also, it's important to know that above and beyond some of the things that Carl mentioned, value is also about looking for companies that have wide moats, high barriers to entry. Think of best example would be thinking of like a castle where you have a wide moat with alligators in the water, and then that drawbridge, right? The wider that moat, the wider the amount of water around that castle, or in essence, the more challenging it is for a company to try to capitalize within a specific industry. That is very crucial. This is why you see certain companies being dominant players like the Coca-Colas of the world, which is probably one of the more classic examples to where it's really difficult to interject and actually come into their business model because of their overall scale and just their overall dominance with that moat. Those are the things that we're looking at in particular, and feel free to ask us questions about this specifically with some of the stock selection we've done in the space, but even more so some of the funds that we're using there.
Next question, and just a reminder for our attendees, if you want to ask a question, go ahead and respond to the invite or reminder email with your question, or you can write it in the chat feature. So this question was previously submitted as well. What do you think the probability of a recession is, and do you predict that there will be one soon? If so, what measures is Verde taking to safeguard against a recession?
As I stated before, I think the probability of recession is under 30%, right? Which means the probability of no recession is 70%. And again, we can't see, asking me like, is a recession coming, is like asking, is winter coming? Yes, it's always coming, right? But the reality is it coming right now, right? So we can see typically with our recession risk forecast up to 12 months in advance. And right now, our recession risk dashboard does not show an imminent recession. Now, recessions can be self-fulfilling prophecies, meaning if enough people start to change their behavior because they perceive a recession is here or that one will be coming, we certainly can get one, right? If there's enough of that perception. But we don't see that to be the case. We see that consumer spending is still very robust. We see people traveling. We see that people are still using excess savings, and more importantly, people are still borrowing on credit cards to fuel their consumption. So if anything, the number that we got today on the consumer price index just shows that we actually have the opposite problem, not a lack of demand, too much demand. So again, low probability of recession this year. Next year is a different story, but this year we don't see one. We see 20-30% probability.
Hi, everyone. I just want to add something. This is Tommy. I think that sometimes when we're talking about recession, or even in this year, inflation, higher inflation, which we have all been maybe a bit spoiled over the last 30 plus years and not having to really talk about higher inflation. But some inflation is actually a good sign. It means that the economy is hot, it's robust, it's growing. And part of the reason why we have such a hot economy over the last couple of years is because of the consumer, right? It drives a good portion of our economic growth, our GDP, or gross domestic product here in the US. And because the consumer has been doing so well, there, as Carl just indicated, and he indicated earlier in the presentation, that people are still out spending money. Their spending behaviors may have shifted over the last 2 years since the pandemic began, when in the beginning people were spending more on products, right? They were at home more. Now they're out at restaurants and traveling, right? So maybe it's more service-oriented spending. But either way, as long as the consumer is still doing well, is still out spending money, and as Carl indicated, right, we believe collectively because they have higher wages, right? They've got an accumulated amount of savings and the ability to borrow easily, whether it's credit or other abilities. We feel that, or we believe that this year the probability of recession is still quite low, like Carl indicated. One thing to note is that you may have heard the term savings saves the day. The savings rate jumped during the beginning of the pandemic quite high. Between 2015 and 2020, the savings rate here in the US was 7.4%, which is historically really high. Today, it's closer to 4% savings rate, which is still high. But even if prices are higher, right, even if the cost of goods or services sold are higher this year, a lot of people are still spending because they're drawing down that savings that they have built up over the last couple of years.
Another question. I'm retired and concerned about how inflation is affecting my buying power on my fixed income. What do you recommend I and other retirees do?
Inflation doesn't have to affect you to the same degree as everybody else. So I want you to know that, again, if I go back in the slides for just a second, inflation is a byproduct of a bunch of different components, right? And the two biggest that we see inflating right now are housing and transportation, okay? 97% of us this year are not going to buy a new house or move from our existing house, right? If you are staying in the same house that you are already in, and you are in a 30-year fixed mortgage, or you've paid off your mortgage, inflation really will not affect you. It doesn't matter that your neighbor's house went up 20% in value. If you're staying in the same house that you are in, that number isn't going to affect you. Same thing with transportation, right? If you can fix up your car and not need to buy a new car, and again, only about 20% of the US population buys a new car in a year, so 80% is not buying a new car this year. That portion of the inflation doesn't have to affect you. So don't feel like you have to be a victim to this. There are certain things that you cannot live without, like food, for example, but there are many, many decisions that you can make to protect yourself against inflation. A lot of us, for example, have the choice to work from home if we want to. If you're finding that the price of gas is really crimping your ability to spend on other things because you're driving very far, consider working from home a couple of days a week, right? And not having to drive into the office, or consider moving closer to your job so that you don't have to drive that far anyway, right? There are things that you can do to protect against that. In retirement, there are fewer choices, but hopefully by the time you're retired, you're well settled with your housing, and you've got transportation that hopefully is you don't need to go a bunch of different places. So in that situation, inflation should not be a major hit to your spending.
We have time for one last question. This was submitted via the chat. Now is a good time to accumulate undervalued assets such as NVIDIA. In what ways, or how aggressively, will Verde leverage that opportunity?
Good question. As fast as we can. That's the answer. We are very interested in buying undervalued assets. We know that for the vast majority of our clients, again, even those that are retired, 90+% of your portfolio is not needed for this year. And for those that are in the accumulation phase of life where they're still adding funds to their portfolio, 100% of their portfolio will not be needed this year. So volatility actually plays a really positive impact into that, because when stocks like Nvidia go down, and there are others, PayPal is down this year, Tesla is down this year, Netflix is down this year. Those are all fantastic companies that we can buy at anywhere from 70 cents on the dollar to as low as 30 cents on the dollar from where they were a year ago. We are deploying money as quickly as we can. If you are sitting on excess funds that, like I said, you don't need over the next year or even maybe 2 or 3 years, this is a good time to add money to your portfolio. I don't know that it's going to go up immediately for you, but I do know 3 years from now, 5 years from now, you'll be very happy with that decision. So we are deploying money as quickly as we can get it.
Great. I think that's all the time we have for today. So thank you for attending. If you'd like to share this recording, it will be available on our blog, which you can find at verdecm.com, and we will make sure to send out an email to the entire client base with the link and letting you know when it's posted. If you guys have any more questions, don't hesitate to reach out to your advisors and your advising team here at Verde. We hope you have a great weekend.